This presentation is for Chapter 7, Master Budgets. In Learning Objective 2, we are going to learn about different budget types and the components of the master budget. There are many different ways that companies can create budgets. Some companies will use the previous year's results and modify them for expected changes. In this traditional format, managers may need to only justify changes to the budget from the previous year's actual results. As an alternative, budgets can also be developed using what is called a zero-based budget. In zero-based budgeting, all revenues and expenses must be justified for each new period. This approach assumes that operations are being started for the first time and the previous year's actual results are ignored. Zero-based budgeting is an effective way to limit the inflation of budgets and control unnecessary expenses. Because there are many different ways budgets are created and many different purposes, there are many different types of budgets. We're going to look at some of the different types. This slide illustrates two different types of budgets: strategic budgets and operational budgets. Strategic budgets tend to be about the long-term financial plan of the company, usually 3 to 10 years, and the long-term goals. Because strategic budgets cover such a long period of time, they're usually not as detailed as budgets for shorter periods. The operational budgets are going to cover those short-term financial plans and shorter-term goals. So these are usually going to be for a year, but they can be as short as a week, a month, or a quarter, depending on what the company needs. And of course, they will generally be much more detailed than a strategic budget. Again, the strategic budget is going to be to coordinate the activities for the long-term goals of the company, often 3 to 10 years, and again, they are usually less detailed as budgets for shorter periods. The operational budget, though, will be a short-term financial plan to coordinate the activities needed to achieve short-term goals, and usually will be much more detailed. Some companies will develop a variation of an operational budget that maintains a continuous projection into the future. So a continuous budget is just a type of operational budget that involves continuously adding one additional month as each month goes by. So when a company uses continuous budgeting, the company revises the budget by replacing the month that just ended with a month at the end, so there is always a continuous 12-month period. Continuous budgeting allows a company to constantly monitor the budget and keep track of current and future amounts. A static budget is a budget prepared for only one level of sales volume. For example, Smart Touch Learning, the company that we have used to illustrate accounting concepts in your textbook, may prepare a budget based on annual sales of 2,000 touchscreen tablet computers. All revenue and expense calculations would be shown based on sales of 2,000 tablets only. But a flexible budget is a budget that will be prepared at various levels of sales volume. So this type of budget is useful for doing what we call what-if analysis. Smart Touch Learning may expect to sell 2,000 tablet computers, but a flexible budget showing results for selling 1,600, 1,800, 2,000, or 22,000 tablets allows managers to plan at various sales levels. So the master budget is a set of budgeted financial statements and supporting schedules for the entire organization. It will include the operating budget, the capital expenditures budget, and the financial budget. Budgeted financial statements are financial statements based on budgeted amounts rather than actual amounts. The master budget is operational and static. This exhibit shows the order in which managers prepare the components of the master budget for a manufacturing company, such as Smart Touch Learning. So the schedule shows that the master budget will include those three types of budgets: the operating budget, the capital expenditures budget, and the financial budget. An operating budget is the set of budgets that project sales revenue, cost of goods sold, and selling and administrative expenses. All of that information will feed into the cash budget and then the budgeted financial statement. The first component of the operating budget is the sales budget. That is the cornerstone of the master budget because sales affect most other components of the master budget. A capital expenditures budget is a budget that is going to present the company's plan for purchasing property, plant, equipment, and other long-term assets. Those are called capital assets. Another type of budget, the financial budget, will include the cash budget and the budgeted financial statements. So the cash budget is going to detail how the business expects to go from the beginning cash balance to the desired ending cash balance. These budgeted financial statements will look exactly like ordinary financial statements. The only difference is that they list budgeted or projected amounts rather than actual amounts. And that is the conclusion for Learning Objective 2.